Look at this visual. It shows a single path that suddenly fractures, shooting in two completely opposite directions. This illustrates the sudden split occurring at the top and bottom of the Nifty 50. This split-screen graph maps the fallout from Q1 business updates. On the left, HDFC Bank rallies with a 3.7% gain. On the right, Kotak Mahindra drops 3.9%. Both premium private banks are currently trading below their 5-year average price-to-book multiples. Institutional capital is moving away from one of these deep value stocks and toward the other on the exact same day. To understand why, we have to look past the daily stock charts and examine the operational engines. This price action is a direct reaction to the sector-wide competition for deposits. This 7.6% performance gap identifies which bank actually possesses the liquidity to fund future growth. This matrix provides a systematic way to compare fundamental data, moving past the initial volatility of the trading floor. We start with the top row, credit growth. This measures a bank's ability to lend money and generate yield. HDFC recorded an 8% quarter-on-quarter increase in credit growth, which exceeded street expectations. That growth was supported by high working capital demand and strong corporate loan activity. Kotak, by comparison, largely met baseline expectations for loan growth, failing to match that same level of momentum. While accelerating loan growth is a positive indicator, it requires a significant cash pool to fund. The bank with the highest credit growth must also be able to navigate a tightening deposit market. This leads to the middle row, deposit mobilization. This is where banks compete for the cash reserves required to sustain their lending operations. Kotak's report revealed an operational vulnerability. Their deposit growth remained flat. Data shows a sequential decline in CASA, typically a bank's least expensive funding source. HDFC demonstrated the opposite trend, showing deposit momentum and CASA stability following the merger. Without that cheap funding source, Kotak is required to utilize more expensive term deposits, such as high FCNR rates, to maintain liquidity. Because Kotak is struggling to attract low-cost deposits, their future profit margins are expected to be more compressed than HDFC's. Finally, has the market priced in these outcomes? Kotak trades at a deeply discounted 1.84 times price-to-book. HDFC also sits at a historical discount of 1.95 times. Yet analyst consensus gives HDFC a 100% buy rating with a 26% projected return. Kotak's lower return projection is a reflection of its stalled deposit growth. Investors should be cautious about assuming a recovery is imminent just because the price is low. While HDFC requires a slightly higher premium, it offers proven operational execution. Kotak's lower multiple reflects a business that currently requires significant patience. Looking beyond these two specific stocks, we see a broader macroeconomic shift currently favoring Indian private banks. This chart compares growth projections. Systemic credit growth for private banks is expected to reach 17 to 18%, nearly doubling the 10% projected for PSU banks. HDFC's stabilized deposit base is positioned to capture this projected sector-wide credit increase. Investors seeking to participate in this trend also have established alternatives like ICICI, SBI, or AU Small Finance Bank. In an environment of 18% growth, capital will favor banks that have already secured the deposit capacity needed to lend. This decision tree helps map the data to your portfolio strategy based on your primary investment goal. If your goal is to participate in sector growth, this Q1 update provides evidence that HDFC has resolved its post-merger liquidity concerns. However, if you are looking at the 3.9% drop in Kotak's price as a potential entry point, there are specific risks to consider. High capital allocation here should likely wait until there is sequential evidence that their CASA and total deposits have stabilized. A low valuation provides little protection if the core business remains stalled. Prioritize the bank with active operational momentum over a stock that is sliding while its funding base shrinks.